Welcome back to Stock Daily. It's Thursday, August 29th, 2025, 8:35 p.m. Eastern Time. Today, all four major indexes pulled back and semiconductor stocks saw a sharp sell-off. Interestingly, some of the biggest losers like AMD and Nvidia still held up better in the broader market. So what exactly happened today? Is this just a temporary dip? And more importantly, where are the potential buying opportunities? We'll take a close look at the semiconductor index, a few key stocks, the broader technology sector, and the S&P 500 outlook. Let's start with the big picture. The takeaway here is simple. Don't panic. There are potential buying opportunities ahead. Before we get into stock and index levels, let's look at some important developments. First, the Federal Reserve's ongoing legal case regarding tariffs imposed under the Trump administration remains unresolved. Both sides have been ordered to submit additional documents next week. This uncertainty has pressured the dollar, while 30-year Treasury yields climbed as investors demanded higher risk premiums. Short-term yields moved lower on rate cut expectations, steepening the yield curve and boosting risk sentiment. That's why we saw safe haven assets like gold and silver close at fresh recent highs. Another significant update came after the market closed. A U.S. appeals court ruled that most of Trump's tariffs were unlawful, saying he exceeded his authority. However, this isn't the final word. The case now goes back to a lower court to determine whether the ruling applies broadly to all tariffs or only to the plaintiffs. For now, tariffs remain in effect, keeping the outcome uncertain. Ultimately, the Supreme Court may need to make the final decision. There was also news that all foreign goods valued over $800 will no longer qualify for tariff exemptions. This affects a wide range of products, including clothing, cosmetics, small appliances, electronics, Canadian pharmaceuticals, and European food imports. Advisors estimate this could bring in around $100 billion in additional revenue each year, but it will likely raise consumer prices. The real question is how much of these costs will be absorbed by exporters, importers, or ultimately passed on to consumers. On the data front, July's PCE price index came in largely in line with expectations. Headline inflation rose 0.2% month-over-month and 2.6% year-over-year, while core PCE rose 0.3% month-over-month and 2.9% year-over-year, slightly above the prior 2.8%. The so-called supercore metric rose 0.4%, its third straight month of acceleration, raising fresh concerns about sticky inflation. Market consensus is that core inflation will likely keep trending higher into early 2026, peaking around 3.33% before gradually cooling to 2.5% by year-end. That would give the Fed room to cut rates by 75 basis points this year, and possibly another 50 to 75 basis points in 2026. Several Fed officials reiterated a dovish outlook this week, noting that current rates remain 1.25 to 1.5% above neutral. From my perspective, while forecasts are optimistic, the real driver remains market positioning and capital flows. Rate cuts are likely, but timing and magnitude will depend heavily on incoming labor market data, especially the August jobs report next Friday. Now let's move to semiconductors. The Philadelphia Semiconductor Index dropped sharply, with 29 of its 30 components finishing lower. The one stock that managed to close slightly higher barely held on. If you're looking for a news trigger, reports that Alibaba has developed a new AI chip more powerful than its prior models may have pressured sentiment, as it could reduce reliance on Nvidia chips in China. But overall, this was more about profit-taking after a big run. Here's the key takeaway. Declines in leading semiconductor stocks should be seen as buying opportunities. Earnings-driven rallies in the sector are not finished. A pullback and consolidation phase is healthy and sets up the next leg higher. Let's break down some levels. For the index, potential buy zones come in around 233 for a 5% pullback, 222 for about a 10% correction, and as low as the 211 to 204 range for a deeper 15% retracement. For individual names, Nvidia around $169 is a key support. If it breaks, the next attractive buy level is $159 to $156, about a 9% decline from current prices. Based on forward earnings, the stock is still undervalued below $172, with a reasonable trading range between $172 and $204. AMD faces support at $153. A break lower could open the door to $143, representing roughly a 12% decline. That would mark a more compelling entry point. Broadcom, which slipped 1% today, has intermediate support around $216 and stronger support at $207, representing 6 to 10% downside. Based on forward estimates, the stock looks attractive around $209 to $240. ASML is trickier. Strong support sits near $690, about 8% lower, but management guidance for 2026 remains uncertain. Unlike TSMC, which can increase profitability through pricing and capacity adjustments, ASML depends heavily on customer orders. If demand softens, sales can slow quickly. This makes its outlook more complex. Turning to the mega-cap tech names, Tesla fell below $337 today and continues to chop lower. As long as it holds above $340, the broader uptrend remains intact, but momentum has clearly slowed. Below $340, the next levels to watch are $296 and $265. Microsoft continues to consolidate around the $500 level. Support in the $685 to $700 range remains strong, and a dip there would represent about a 6% pullback, consistent with market averages. Apple has first support near $215, implying 6 to 7% downside from current levels. Amazon faces a key level at $200. A break lower could lead to the $213 to $204 range, again about 7% lower. Now let's zoom out to the S&P 500. The index currently sits at 6466. A correction to the 6100 area would be a 5% pullback, aligning with typical retracements we've seen in history. A deeper correction to 5700 would represent about a 10% move, which would likely push many of the mega-caps into their strongest buy zones. Historically, a 10% correction happens about once per year, while 5% pullbacks occur multiple times annually. So a move to 6100 should be viewed as a normal and even healthy reset. Importantly, fundamentals remain intact. Nearly half of S&P 500 companies raised guidance after Q2 earnings, while only 14 cut forecasts, one of the lowest numbers on record. That's not a backdrop for a collapse. The bottom line is this: corrections create opportunity. We want to be ready to buy high-quality companies with growing earnings when they return to reasonable levels. Patience is key. If the market refuses to pull back and keeps grinding higher, we manage risk accordingly. But if we do get a correction, we should welcome it as a chance to build positions at better valuations. Looking ahead, this weekend we'll update our forward earnings models for 2025 and 2026, including S&P 500 fair value ranges and sector-by-sector growth estimates across all 13 industries. This will help us identify which sectors are positioned to outperform the index and where new opportunities may emerge. That's it for today's market update. Thank you for watching, and we'll see you again next Tuesday at the same time.